Most traders don't fail because they're bad at reading charts. They fail because they're obsessed with being right. They think consistency means winning every trade. They think a good trader is someone who never takes a loss. And that belief quietly destroys them long before their account hits zero. Real consistency has nothing to do with streaks. It has nothing to do with prediction. Consistency is a system, a process, a set of rules you follow even when your emotions are screaming at you to do the opposite. And that system begins with one decision most traders never commit to. The 1-hour chart. Here's the uncomfortable truth most people avoid. The majority of retail traders don't lose because their strategy is broken. They lose because their mind is overloaded. They jump from the 5-minute chart to the 15-minute, then to the 1 hour, then back down again. Every chart tells a different story. Every candle triggers a new emotion. They're conviction fractures in real time. They cut winners short because they're scared. They hold losers because they're hopeful, and they call it analysis when it's really just confusion. The 1-hour chart solves this problem at the root. It's the Goldilocks time frame. Fast enough to offer real opportunities during the trading day, slow enough to filter out meaningless noise. It forces patience onto a mind that craves action. And most traders hate that. But this is where the separation begins. An amateur trades the 1-hour chart emotionally. They see a setup and enter because it looks good. A professional trades the 1-hour chart mechanically. They see the same setup and ask a single question: does this fit my system? If the answer is no, they walk away. No frustration, no regret, no second guessing. That's real consistency. Not being right more often, being disciplined more often. In the next few minutes, you're going to learn 5 non-negotiable rules that professionals use to turn the 1-hour chart into a reliability machine. Nothing flashy, nothing revolutionary. In fact, they're boring. And boring is profitable. By the end, you'll have a framework that removes emotion from your decisions. You won't guess. You won't hope. You'll execute. But there's a catch. You must follow it even when the market rewards breaking the rules. Especially then, that's where most traders fail. They follow the system for 3 trades. Then on the 4th, they feel something coming. They size up. They bend the rules. And the market reminds them who's in control. Understand this first. The 1-hour chart is your stage. Every entry, every exit, every loss. It teaches you something about yourself. On lower time frames, price can spike on a headline, an algorithm, or a single large order. Those moves look important, but they mean nothing. On the 5-minute chart, you're trading ghosts. On the 1-hour chart, price has to prove itself. It must hold structure for 60 minutes. It can't fake conviction. That's why professionals gravitate here. It's the smallest time frame where structure is real. But here's what most traders miss. The 1-hour chart doesn't just filter noise. It forces patience onto a psychology that's addicted to action. Trading isn't an analysis problem. It's a boredom problem disguised as one. Most traders don't lack knowledge. They lack restraint. They want to trade now, so they find a reason to enter. The 1-hour chart removes that temptation. In an 8-hour trading day, you'll see 8 candles. Out of those, maybe 2 or 3 are legitimate setups. The rest of the time, you're doing nothing. And that's the hardest trade there is. Doing nothing feels like failure. It feels like missing out. It feels like leaving money on the table. Professionals understand something amateurs don't. The best trade is often the one you don't take. Waiting is not weakness. Waiting is position. This lesson only works if you commit fully. One time frame. The 1 hour. Nothing else. No checking the 5-minute for confirmation. No glancing at the 4-hour for reassurance. One chart. One perspective. This single commitment separates traders who make money from traders who talk about trading. The ones who talk are addicted to multiple time frames. The ones who make money aren't. Here's why. A trader once had a solid win rate. over 50%. But every winner was small, and every loser was large. He wasn't undisciplined. He wasn't reckless. He was trading good setups at bad times. Market structure during his trading hours worked against him. His math was broken before the trade even began. Then, he made one change. He traded the same system, the same rules, the same discipline, but only during a specific liquidity window. Suddenly, his winners doubled. His losers shrank. His win rate stayed the same. The edge appeared out of nowhere. It wasn't the strategy. It was the timing. This is the invisible killer most traders never see. They think their system is broken when their environment is broken. It's like trying to hit a target during an earthquake. Skill doesn't matter when conditions are hostile. The rule is simple and non-negotiable. You trade the 1-hour chart only during your instrument's highest liquidity window. Outside that window, you do nothing. For stock indices, that's the open when volume floods in. For major currency pairs, it's when institutional participation overlaps. For crypto, it's whenever your mind is sharp and focused. Liquidity isn't just about volume, it's about clarity. Write this rule down. Make it visible. I trade the 1-hour chart only during my defined window. No exceptions. This rule alone removes most weak signals and eliminates constant overtrading. Professionals don't trade all day. They trade their window. Outside of it, they're unavailable to the market. Amateurs are always on. Alerts buzzing. Charts everywhere. That vigilance doesn't increase edge. It destroys it. Once your window is locked in, the next step is recognizing quality price action inside it. Markets behave differently when liquidity is real. Levels matter. Structure forms. False moves die quickly. This is where pivotal points come in. Most traders see any bounce and call it a setup. Professionals don't. They look for hesitation, pause, rejection. A pivotal point isn't momentum, it's resistance to movement. Price pauses. It consolidates. It shows that one side is defending a level. An amateur sees price drop and bounce. A professional asks 3 questions. Did price pause for multiple candles? Did rejection appear? Did structure form? If the answer isn't yes to all 3, it's not a setup. It's noise. A pivotal point isn't an indicator. It's a pattern. It's where larger players absorb pressure and take control. Here's the critical difference. A bounce is easy to see. Rejection requires patience. Rejection shows up as long wicks, strong closes, or volume spikes at a level. It's the market saying, "We're not going lower." That's the signal. Then comes the third question. Is there directional confirmation? After the pivotal point forms, does price actually move in your intended direction? This tells you the battle is over. If price pauses beautifully but the next candle closes against you, you wait. That's not confirmation. That's a trap forming. Professionals wait, and then they wait some more. If confirmation never comes, they walk away without regret. This is where most traders fail. They see structure forming and enter early because it looks right. They don't wait for proof. Waiting feels uncomfortable. But waiting is the edge. If you filter out mediocre setups and only take confirmed ones, your math changes completely. Your win rate becomes less important. Your average winner grows. Your average loser shrinks. That's how accounts compound. Here's the psychological shift most people miss. When you enter after full confirmation, you trade with conviction. You're not guessing, you're executing. That conviction changes everything. You don't panic on small pullbacks. You don't take profit early out of fear. You hold because you trust the process. Amateurs don't have this conviction. They enter on hope. Hope cuts winners short and stretches losses. Structure creates patience. Patience creates profit. Now, there's one thing that destroys traders faster than bad setups. Good setups with bad position sizing. This is the silent account killer. You can have perfect entries, perfect stops, perfect exits, and still blow up if your size is wrong. Professionals understand this hierarchy. Risk comes before entry. Always. Amateurs think about size after the trade starts working. That's already too late. If you risk too much, a normal losing streak becomes catastrophic, and losing streaks are part of trading. This isn't opinion. It's math. Risking too much doesn't just damage your account. It damages your mind. Smaller risk keeps you alive. And survival is the first requirement for success. The rule is simple. On every 1-hour trade, within your window, you risk a small, fixed percentage of your account. No exceptions. Position size is calculated from the stop loss, not the profit target. The stop defines the risk. The risk defines the size. This removes greed from the equation completely. The math becomes the authority. And the math doesn't negotiate. When you follow this protocol, something powerful happens. You stop fearing losses. You stop chasing wins. You focus on execution. And over time, that execution compounds. From this point forward, when you look at the 1-hour chart, don't ask if you should trade. Ask if the setup earns the trade. If it doesn't, you wait. And when it does, you execute with calm, confidence, and control. That's consistency. Not excitement. Not prediction. Discipline. Repeated long enough for the math to work. And that's how professionals trade.